the point of that is that there is great opportunity still available in the miners. If someone doesn't have exposure and wants to get it, it's not too late. Whereas it might be too late to jump into the S&P now and, jump into maybe some cryptos or something, or jump into real estate.
And exactly as you're mentioning at this time, Jeff, when we look at all of the other bubbles that exist right now, why do you think it is that the gold and silver miners are seemingly the only place that isn't sitting at record high P/E ratios?
I would go back to my previous answer. It's because gold and silver are down. They're going to follow and track and do what gold and silver do with leverage, either direction. But because gold and silver haven't attracted the mainstream back to their market yet, the mainstream hasn't looked at gold and silver miners yet. So the point of that is that there is great opportunity still available in the miners. If someone doesn't have exposure and wants to get it, it's not too late. Whereas it might be too late to jump into the S&P now and, jump into maybe some cryptos or something, or jump into real estate. Those things have admittedly run up a lot in value. The only thing that hasn't is gold and silver and mining stocks. So the value is still there. But the answer to your question is because gold and silver haven't moved, the miners haven't moved yet either. I do think that's going to change.
Jeff, you mentioned some of the fundamental drivers that we saw in the 70s and the 80s. So right now we're seeing record high inflation that we haven't seen for many, many years. Powell came out this week and said that we're going to stop using the word transitory when talking about inflation. So how do you see the inflation story persisting? And maybe as part of that, do you think that a lot of these supply chain issues are, one of the main reasons that we're seeing this inflation?
Yeah, they've admitted as much, and many analysts have admitted as much, that it's not just a demand issue, it's also a supply chain issue. And I think everybody knows that. Everybody knew that when the Fed started using this transitory word. I mean, just every day we were bombarded, transitory, right? Make it the word of the year. I mean, these guys just pounded it into our head. And I was very skeptical. And I even said publicly, look, I don't think it's going to be transitory. And now look what the Fed is saying, like you just cited there. They're saying, well, it's time to retire that word. It's going to last well into 2022. Many supply side manufacturers, transportation, all these things are saying it's going to last into 2022. Be prepared for it. So, the Fed was wrong then. So, and they've been wrong many times, right? Remember Bernanke saying the housing market is stable in 2006. He was horribly wrong. So I wouldn't follow the advice of what a Fed official or a government official is, a vested interest in trying to be positive and, trying to, keep the market stable and up and that sort of thing. I wouldn't put my trust in that, And again, the evidence of that is all the supply side manufacturers and the whole chain was saying, look, this is a problem. This is going to last a while. And that's exactly what's playing out. So I do still fall into the inflation camp that it's going to go higher. But here's the thing, there's good evidence for deflation out there, that could be coming. And there's good evidence that we could be going into a stagflation. So what's it going to be? Well, Tom, I sleep well at night because I don't have to answer that question. Mm-hmm. If I own a meaningful amount of physical gold, I don't have to answer that question because it's not about inflation or deflation. It's about crisis. And when there is another crisis, gold is going to do its job. It has historically for 3,000 years. And so while it's fun to talk about these issues and debate them and say, I think I'm right, it's going to be inflation or it's going to be deflation, I enjoy those debates. But at the end of the day, it really doesn't matter if I have a meaningful amount of physical gold under my control. And so that's what I focus on. I really do.
I'd like to go back to talking about the miners with you, Jeff, because you've spent a lot of time analyzing them. So do you follow what big investors like Eric Sprott, for instance, invest in for a guide to seeing what is interesting to him?
To a certain extent, yes, but I don't necessarily want to mimic what Eric Sprott does. Eric Sprott is a billionaire, so he's got a few more resources than I do. So he can absorb a loss, for example, more than I can. He can afford to invest in 100 or 110 mining stocks, whatever it is he owns right now. He can afford to take more risks than I can. But that said, I do like to look at certain things that he does, like what are his largest investments? What does he put the most capital into? An example there would be First Majestic Silver. He's put a lot, over $500 million into First Majestic. Now, he did sell some recently, but his position in that company is still very, very high. I might look at who he's bought more than once. Has he invested more than once into a stock? An example there would be Silver One, small silver junior in Nevada. He's invested 3 times into Silver One. So that makes me think, he's positive about that. So, an investment by Eric Sprott is not a guarantee that it's going to be successful because he doesn't have to be successful with every single one. But yes, I like to look at the trends and where he's putting more of his capital and how he's investing to give me some clues about where I might want to look.
Jeff, you've been on many site visits. So can you share with us a story about what a site visit can reveal to you that you might have missed otherwise?
That's a great question. A good example would be, let's see, the last one I was at, I think, was First Majestic Silver. They bought that gold mine in Nevada. So they were diversifying into gold and out of Mexico. They had an analyst tour. I was invited to go and I went. And the first thing I noticed was there was some criticism, a little backdrop real quick. There was some criticism because it wasn't necessarily a well-run operation. Let's just put it that way. Costs were very high. So why in the world would First Majestic buy this, right? Well, they're turnaround specialists. That's what they've done with most of their other assets. They've taken weak or underexplored ones and improved them and turned them around. That's what they want to do with this one. Anyway, when I showed up, I thought, okay, let's see, what's going on here. And the first thing that hit me was just how big this was. This is a huge operation. It's very, very big. I stood at the bottom of the open pit and I had posted some pictures of this on Twitter, I believe. And you can look up and just see how big this. It used to be an open pit mine and now it's an underground one, but the pit is still there. We're standing on the bottom looking up and it's huge. It's like being inside a giant football stadium. It's huge. And then I realized that what they're doing is they're taking the 2 underground drifts, they're called, the tunnels and mine shafts, and they're digging toward each other and trying to meet to connect them. And that is one way they'll improve the efficiency. We got to see that. So I think being on site and actually seeing the rock, seeing the operation, looking management in the eye, I really like to do that. I don't take their word for it. It's part of being an analyst is looking them in the eye, asking tough questions, asking honest, tough questions, about things. I think that all adds to the value of determining whether or not this is a good investment. So that's what I try to do.